Hello guys, welcome back to Channel for Trading. This is the fourth episode of All About Options in Channel for Trading. Today we are going to see two more income strategies, and the first among them is long iron butterfly, and the next strategy in this episode I'll be talking about long iron condor. Till episode 3 we have seen strategies which has two legs position. From this episode we are going to see a strategy which has four legs. So this is little more advanced than the strategy what we discussed till episode 3, and in long iron butterfly this is an intermediate strategy that can be profitable for stocks which are kind of range bound, and this is actually a combination of bull put spread and bear call spread. So these strategies I have explained in episode 3. If you have not watched that video, I highly recommend that you watch that first, and if you come back to this episode it will be easy to understand. Okay, continuing here, usually traders will take this strategy by first trading a bull put spread near to the support region, and then as the stock rebounds from the resistance area they will add a bear call spread, and the combination of this we call it as long iron butterfly. So if it is not clear on what is bear call spread, what is bull put spread, please watch the episode 3, the previous episode. You will get a fair understanding and you will be in a better position to understand the long iron butterfly. So here it has four legs which I already discussed, and the concept here is go long with an OTM PE and go short with ATM PE, then go short with ATM CE and go long with OTM CE. And keep in mind the shorting for ATM PE and ATM CE should have same strike price, and all these should have same interval of strike price. That means OTM PE for long and short should have a fixed range in between in choosing all these things. Okay, and all these call and put should have same expiry. So that defines long iron butterfly. Now let's see the overview. It will give you a much better understanding, and then the option Greeks of the same. So the overview here is what is the strategy we discussed: buy OTM PE and then sell ATM PE, added together with sell ATM CE and buy OTM CE. So from here you can see this is a combination of bear call spread and bull put spread. So combination of those two we call it as long iron butterfly. Here again the net credit is premium sold minus premium bought, and the maximum risk difference in adjacent strikes minus net credit. We will see it with an example, so don't worry if you're not able to understand. In the next slide we will be able to get a better picture. The maximum reward here is net credit received, and the break even on the upper side is short ATM PE strike plus net credit, and break even down short ATM CE strike minus net credit. When to deploy? So this you have to deploy this strategy if you have a neutral view for a particular stock or an index, which the stock is expected to move within a fixed range. The effect of time decay in your favor, it will erode the value of CE and PE sold as we know now. But this strategy also has buy position, so execute this strategy for short time periods only. Okay, 1 month or similar. Don't go with below that. I mean above that. It is fine to go below that. And option Greeks, these are the values for delta, vega, gamma and theta. It is self-explanatory, so I'm not spending time on this one. You can just go through, pause the video and go through these values. Now let's see the trading example. Here is the interesting part for this strategy. So this is the format I follow always for a strategy. First I'll explain what is the strategy, how many legs it is. Then I'll give you an overview and an option Greek, and then I'll give you a trading example. So if you've seen the previous 3 videos, it is the same format for all the strategies which I am following, and in this episode also the same. So it is easy to compare. Even if you want to compare one strategy with the other one, it is easy to do so, and to get an understanding also I feel this is much better to understand, because I have learned options using the same. I have prepared similar kind of data and then going through that multiple times and taking trades in live market. That's the way I learned it. So I'm trying to give you all the same way of information so that you can also be familiar with all these strategies. Okay, without any further delay, let's look at the trading example. So consider stock A is trading at rupees 1875 on December 28, 2020. Buy one lot of 28 Jan 1500 PE for rupees 22.5 and sell one lot of 28 Jan 1875 PE for rupees 112. And I have, for this calculation, I have rounded off all these values. I have rounded off it like 23, maybe 112, here at 38, something like that. So that will be slight changes in the values here. So please bear it in mind. Okay. For the easiness of calculation, I have rounded it off. Okay. And sell one lot of 28 Jan 1875 PE for 112.5. Sell one lot of 28 Jan 1875 CE for rupees 150. Here you can see the PE and CE are both of same strike price. I have chosen for PE and CE for the selling. That is very important. That makes the long iron butterfly. And buying one lot of 28 Jan 2021 2250 CE for rupees 37.5, or rounded off it as 38. Now let's see what is a net credit and max risk. Here net credit is what is the amount what we have sold and what is the premium we have bought. Fine. So sell, you have to add this. As I said, I rounded off this, so 150 plus 112 I have considered here. And what is the premium which I have paid for buying the options? So this one and maybe this one, right? So I have rounded off it. I took it as 61 almost. Maybe here as 38 and 23 I have considered, so it is 61. And net credit is 201. And maximum risk is difference in adjacent strikes. So here you can see the difference in adjacent strike is of 375. So maximum risk will be 375 minus net credit. Okay. And maximum reward is, we all know it is net credit, that is 201, and break even on the upper side, that is the middle strike, whatever we are choosing, right? For PE and CE, both are the same. So the same strike plus net credit, that is the break even on the upper side. And the similar way, break even on the downside, the middle strike minus net credit. So this is the one. Okay, I hope you are able to understand this. And the major advantage and disadvantage: comparatively high profit potential if the stock remains range bound. So as I said, this strategy you have to deploy if you are thinking the stock is in sideways movement. It is not a bullish or it is not bearish. And the disadvantage is the higher profit potential only comes near the expiry date, okay, or the last hours of expiry date, I would say, the market hours. That is the downside or the disadvantage of this. Now let's see the next in this income strategy, and the last one for this episode, it is the long iron condor. I'm going little fast because the video is getting a little longer. It's almost 10 minutes, so I will go a little faster. So what is long iron condor? It is similar to long iron butterfly. Subtle differences. The one is the strike of short PE to choose lower than short CE. In long iron butterfly, we have chosen the same strike price, which is of ATM. Here it is OTM and different strike price, and the PE should be always lesser than the CE strike. These are the difference. Remaining everything is the same. This strategy also you should deploy when you think the stock is of sideways movement, not bullish, not bearish. Okay, and the next one here, the similar way, the strategy here, as we know, this is also similar to bull put spread and bear call spread. Okay, it's the same. The difference which I mentioned you with long iron butterfly, that is only difference. Remaining everything remains the same. So due to that difference in strike price, you can see there is a slight difference in the option Greeks also. You can compare it with the previous option Greek. You will understand that. Okay. So I'm not going to spend more time here. Let's look at the trading example. Here, the same way, stock A is trading at rupees 2100 on December 28. Buy one lot of 28 Jan 2021 1500 PE for rupees 19 and sell one lot of 28th Jan 1875 PE for rupees 94 and sell one lot of 28th Jan 2021 2250 CE for rupees 98. As you can see here, the PE strike, whatever we have chosen, is below the strike of CE what we are selling. Both are OTM. Okay, you can see here the calculation based on that, and the last point in this one, the major advantage and disadvantage. This also has the same advantage and disadvantage as in long iron butterfly, so I'm not repeating it, but I'm here quoting a different advantage and disadvantage. These things are applicable for long iron butterfly also. So the advantage and disadvantage is kind of similar for both. So I have chosen to mention here different one. It's applicable for both. So it is profit from a range bound stock for no cost and low downside risk. The higher profit potential comes with a narrower range between the wing strikes. So that is a disadvantage because the maximum potential is very hard to get it. We have to be so sure with the range. It should be within that narrow range. So it is very difficult to achieve that, and the higher profit will come only then. So that is the disadvantage of it. So I think I was little fast, but that is one of the feedback which I got. My videos are a little bit lagging. I kind of speak slow in those videos. So I tried changing that approach, and I'm trying to talk little fast in this one. So I hope that makes a difference. Please let me know the feedback as always. That's all for this episode. Thank you for watching. Have a nice day. Bye-bye.